transact any type of asset. So if you look at it that way, that's probably the best way to see it, that the technology stack itself is really the most effective way. So all these billions of dollars that exchanges spend every year, I mean, well, over a lifetime, they spend, the banks spend on creating infrastructure. A lot of that infrastructure can eventually just be minimized, and transactions can have with less friction on a global basis. So, you know, I got into this 3 years ago, pretty full time, working with a top early investor, a friend of mine, Mike Turpin, and he's actually someone who I worked with. He was the first partnership I did at NASDAQ with a company called MarketWire. So we've known each other for 15 years. So he was an early investor in Ethereum, Bitcoin, you know, he started Bid Angels. So he had this strategy, he had like almost like a PR firm, but what I did, I came in and we started doing strategy advisory, and got to see a lot of great projects. And then I started the fund in January, because what I was looking at was the concept of a lot of these projects that had already raised money but kind of started to run out. They already had listed their token. They were trading on Binance and some of the major exchanges. They still needed capital. And my whole concept was, let's be a multi-strat fund where I can invest in basically anything. Because I don't think I have a crystal ball that will tell me which blockchain company is going to be the next Google. But what I do have is I can put capital in via a token, via equity, via public equity. There are some public companies in this space now. And use my expertise and my background and my colleagues to create opportunities that are outside returns. So that's the way we look at it. From a financial engineering standpoint, I would say that like HFT systems and all that stuff, like if that's where it's more in line, they're here. So I can give you a little bit of what's going on and color around it. It's going very institutional. Guys like me are showing up, you know, Galaxy's Mike Novogratz, which is, you know, hedge fund manager. You have the Winklevoss twins, right? You got Coinbase. A lot of the guys who are involved in it now, a lot of the people involved, the men and women involved in it now, are from the traditional banking side. And we are usually people who had innovation roles at the banks and exchanges and so on. So that's what I noticed. I noticed people who were like in strategy or who were in corporate development or innovation, you know, groups, Skunk Works, that type of stuff, have ended up in crypto when I talk to them. And, you know, the really interesting part is that everything that we have in the equities world and everything we had in options and the option to commodities futures environment is now being replicated here, but it's using this new technology system that is much more efficient. It's using this blockchain class, right, stack that is much more efficient than existing financial markets. It's also much cheaper, and the barrier to entry for, let's say, spinning up a crypto exchange is very low. So things like that used to cost, you know, when I was at NASDAQ, we had in Trumbull, Connecticut, they have, I think they still do, but they have massive data center, people with guns outside. You know, it was like the hub, was the heart of NASDAQ. If that thing got hit, we'd be in trouble. Now with cloud and distribution and decentralization, you don't really have to have that anymore. And the barrier to create an exchange, except for regulatory, is from a technology standpoint, is literally as easy as spinning something up overnight. So the world has completely changed from what I've seen back in my early days at Lehman, going through the internet phase and building a lot of the first websites and fintech platforms for Citibank and NASDAQ and Chase and so on, and then going into blockchain. It's just an evolution. And what's really interesting is that everything that you guys are working on and now is, so everything you learn on the financial services side or the financial infrastructure side, you realize that it has to be, it's being replicated on this side. I'll stop there. I don't know exactly how you guys want to approach this this call, but I'll stop there for now.
Well, Enzo, I mean, wow, okay. Let's just wait a second, because there's two main topics I would love to take in with you. The first one is what you said last, which is, you know, I guess we would love to know what the job of the future for these students are going to look like, because they're all looking for hedge funds and they're looking to work for Goldman Sachs. Maybe what you're saying is, I don't know, maybe, you know, it's going to be very different and much more, quote unquote, easier for you to set up your own fund. I mean, I had a podcast last week with someone from Inca Digital, where basically essentially saying that the whole compliance aspects that used to reside with a bank, now with blockchain, frankly, anyone could do it, because the data just doesn't reside in this area with guns at wherever the bank is. So you seem to be saying the same thing about you know, investing and capital investing. So what is this going to look like?
So
Okay.
the fact is that even hedge funds now, I mean, even if you're not in cryptocurrencies, let's forget about the cryptocurrency space for a second. The stack, blockchain stack, the idea of the general ledger database. So right now, if you trade, right, like every single investment bank has to have its own ledger, right? They do. Everyone has their own ledger, and then they basically look. They do the transactions. There's and breaks will spit out, and things will spit out problems or whatever, and a discrepancy, and then they fix it. Imagine just getting rid of that and just having one ledger. Everybody's attached to it. You've just literally erased a tremendous amount of friction, right? So there's two major things. One is, if you do get a job at Goldman Sachs, right, or at a hedge fund, you're going to be probably using, you know, the systems will look the same potentially, but in the back end, a lot of this will be digital asset technology. That's definitely going to happen. In fact, one of the companies we invested into, called Quant Network, is run by the person who is the head of cybersecurity for the Bank of England. The customers who he has CNET is 1,500 European banks and payment processors. And what this guy has done is he's created like a interoperability operating system between different blockchains. So different blockchains can talk to one another, or asset classes can go from Ethereum to whatever other asset. So it's very technical. I look at him like a Cisco router. When I'm like an internet guy, right? So I look at him and I say, you remind me of Cisco. You're like the router. And he is in now with MIT and Microsoft, and they're building some other, like they're working for like the Federal Reserve banks, the Boston one, the one in New York. I mean, it's so that's the technology is being used to do this. So for you, it may not be. You either might be exposed to it, but even if you're in a normal daily trading environment, if you're doing, you know, algos and quant trading, the equities might be sitting on digital asset platforms. So you may want to learn a little bit about blockchain, how it works, smart contracts, writing smart contracts, come up with different algorithms that can do HFT. I mean, there's a lot of algos actually just sitting all out there for crypto, like currency trading. You can even take one of those, rip it apart and just kind of understand that idea. But what's interesting too is that as you mentioned, is that the barrier to entry, is very much lower now. I mean, it's so like if I want to buy an HFT bot right now, I could literally buy one. I can license one for. It's not that hard to get. I mean, it used to be much more complicated, right? All this stuff was much more complicated. The other thing about hedge funds is that the markets, so here's something, this is why you should look into this world. The efficiency of the markets, right? Hedge funds struggle right now creating alpha, okay? I'm not gonna tell you my alpha, but I'm beating every single hedge fund, and I'm beating Bitcoin. And it's not that difficult what I'm doing. It's actually basically an arb at the end of the day. but I invest with the companies and I buy tokens from them. Like, you know, I'm doing it more like almost like a private equity venture capital approach to getting the tokens, but I just buy them on exchanges too. But so look at it this way. There's inefficiencies in the market. You usually want to go where there's inefficiencies, and then you want to create algos that leverage those inefficiencies to create alpha. That's net, that's what you're trying to do. In the equities market, you know, if you look at the biggest hedge fund in the world, which is Bridgewater and Ray Dalio, he's still having problems because they literally have made, you know, if you remember the efficiency curve, you probably guys learn that stuff. They're like at the top of the efficiency curve. Everything's too efficient with the equity market. And it's going to become even more efficient until a point. I mean, it's almost like it's impossible to make any money because somebody's faster than you. Someone put a server next to the NASDAQ server or next to the CBOE server in the data center that you don't have access to. So you're kind of a little bit behind. So you have to come up with a strategy that's going to allow you to effectively trade in that environment. So I would say in this market though, it's a little bit of Wild West. I'll admit that definitely. But the CFTC is going to be our regulator mostly, not the SEC. But the interesting thing about it is that there's tremendous inefficiencies at some level. Even though blockchain's efficient, but the crypto exchanges and the pricing and what's out there is inefficient.
Enzo, first of all, thank you on behalf of everyone here for taking the time. I wanted to introduce a little bit about what we're doing here on the MFE program at Lehigh. So a group of us are working with Liz and Zane to build out a token analytics library in Python to begin modeling movements, relationships within these tokens, taking the time to understand smart contracts, how they work, writing our own, really kind of getting hands-on dirty. So I guess my question for you is, and I don't obviously expect sort of spilling the secrets here on the alpha, but one of the things I'm personally working on is the modeling of tokens and token returns. You just mentioned that pricing is extremely inefficient. And so the interesting thing is we have a group modeling token returns, and we have a group factor modeling equity returns as well. And I've had the pleasure to be on both of them. But my question for you is, right, we have certain assumptions in equity markets when we go ahead and model them. How do those assumptions break down when we look at tokens, and kind of are there crossovers between factor modeling tokens, factor modeling equities? Where should we focus our energy to derive this so-called alpha within tokens?
That's a great question. So here, one of the things that we started doing was research in a fundamental equity approach. I have my partner, my current guy's a CFA, Wes Levitt, who's a GP here and the head of Data Token, which is like a top 30 or 40 token. He's a CFA. So a lot of us have that traditional experience, right? I'm not an analyst I'm not a CFA guy, but I'm basically what you would call a deal person. I like to do M&A and all that stuff. So, but what's interesting about what we've been doing is we've been looking at those correlations. I think when you start modeling equities versus crypto, the inefficiencies of the markets are really based on multiple things. One is a deregulated market. That's probably the most core issue here is that the markets are deregulated, meaning the regulations are kind of all over the place. Like it's such a new business. So some of the things that you would see in the markets before it became heavily regulated are things that you'll see here. So you can't trust everything that you're seeing, basically is what I'm saying. So you have to look for ways to try to find information and data and collect it from multiple sources in order to verify.
Understood. So so obviously DCF, kind of traditional valuation of a token. So the traditional valuation of an equity no longer holds. Makes sense.
Well, so we look at when we did Celsius, which and I can share one of the research reports with the.
That would be fantastic.
Make sure, yeah. So the Celsius one, so Nick Birnbaum, who's the head analyst, Nick's Series 7 MBA, blah blah blah, and we started following him when it was 11 cents the token. What the interesting thing about tokens is that they have certain key factors that an equity has. So I have a lot of investor relations, like the companies that put investor relations companies, proxy solicitors, proxy fights, all that stuff. That's my world, the issuer. So when I looked at tokens, they have 2 out of the 3 kind of components of an equity. One is some of them have voting rights, which is similar to an equity. Secondly, some of them there is a voting right in the stakeholder or the fact that they're on a market, meaning that even though there may not be a voting right, you can vote with your feet, right? You can vote by buying it or not buying it or selling it. So they have stakeholders, and they've also built up these kind of communities. So all the major crypto tokens, all tokens that have any idea of what they're doing, have a Telegram group of 20,000 people. Some of them are bots, obviously, but this is what I'm talking about, misinformation. You got to look at what's real and what's not real. You got to peel the onion back. But a lot of them have stakeholder communities. Celsius, they call themselves the Celsians, okay? These people are it's like a cult, all right? And he has 150,000 account holders. He had 2,000 people invest in his private equity round. Lately, it was oversubscribed. He's completely retail. Hardly any institutional. There's maybe the institutional is Tether. They invested. But everybody else is retail. And they put up this data. They follow him because the blockchain tells everything. You can literally find anything, right?
Yeah.
So it's very transparent. So don't forget. So what they do is they have the 3 things. They have the voting sometimes, or vote with your feet. There's transparency, and it's liquid. It just doesn't own any equity in the company. So if I did a DCF, I would say you have to look at the token economics, first of all. That would be the most important thing. But you could say on the balance sheet of the company, if the tokens that they hold, let's say it's $100 million token market cap, but the company, based on their token economic structure and their white paper, states that they control 30% of it. That's $30 million. That technically could go on their balance sheet. And if that token value is going to go up because of the use case of the token economics, you can see that 30 million, if they don't disperse it or sell it, it could turn into 60 million. So you could add another line. There's equity, there's debt, and there's the token, which is literally just another asset class. It's just another, it's like owning real estate, right? So that asset class is part of the DCF equation that no one puts in yet because it doesn't exist. So we've been doing some of that. And there's other funds like Arca Partners, which has, their CFAs also. There's a couple of CFAs that are starting to do some of this work. I'll send you the Celsius one, and you can see how we kind of put it in there.
Interesting. I wanted to follow up on the point that you made about high frequency in this space. Some of us on this call are actually speaking with high frequency firms in Chicago, et cetera. Is that high frequency space similar to that of equities? Just sort of like the modeling?
Oh, you have
modeling
a lot
overlaps.
more.
Is there high frequency overlaps?
You have a lot more inefficiency here for ARB. That's what everyone's doing, ARB. So okay. ARB, so you have multiple exchanges, you have multiple latencies, right? You have latency issues. You also have centralized exchanges versus DEX. You also have, which is a decentralized exchange, which is very slow in some ways, just because blockchain isn't there yet, but it's getting there. Like the Solana chain is supposed to be like, thousands of millions of transactions a second, I'm sorry. So, but sub-second time frame. So back in the day when I was at NASDAQ, this is 10 years ago, sub-second time frame for high frequency trading was 14 milliseconds. Some of the blockchains are now coming out and they're at about 20 milliseconds, but they can't get below 20. And the equity markets is like 2 milliseconds?
Something like
1
that.
1 millisecond? Yeah, it's like something insane. So when you start getting down, this is like an engineering issue, right? This is a physics issue. When you start getting down to the 2 millisecond, 1 millisecond, that's why they're dropping servers like literally right next door to right next door, right? They less places, the less it has to travel, the better off you are. You have a lot more room with the cryptocurrency exchanges. You know, I think the fastest one that I've heard is 20 milliseconds. So, but I don't even know if it works. Like the guys were telling me it's 20 milliseconds, but I haven't seen it work.
Okay.
You know, so this is again so you're kind of going back in time. If I mean, not for you guys, but for me, it's like going back in time. You're literally, and then the other problem is a lot of the rules. The exchanges have no rules, so you should look at exchange rules for trading. You know, your professor will definitely know this. So things like, you know, front running, you know, controlling, manipulations, it's definitely happening. It's hard to see, but it's definitely, sometimes it's not that hard to see. But if you're a person who's been looking at the markets for a long time, you know, you're like, oh, okay.
Something's fishy.
Yeah. It's just, you know, it's not fishy. I mean, like Wall Street, yeah, Wall Street, like someone bought me the book, The Stock Operator. I never even knew this. The Reminiscence of a Stock Operator. It's a very old book from the 20s. And when I read it now, I'm like, holy cow, this is the cryptocurrency market. So
Understood.
it's interesting. Yeah.
Thank
you very much. Thank you very much, Enzo. Just like Brian mentioned, we're working on him on a project as well with some of the other guys in the crypto space. And my interest really lies in the algorithmic trading side. I've been exploring a lot of trading algorithms that work currently on the equity side, I would say, while I try to pretty much model out what the crypto asset space looks like as an asset class. And I just wanted to find out from you, from a portfolio construction basis, how profitable or useful are some of these algorithmic sort of approaches towards your entire strategy as a firm? If you could just speak to that.
So most of the bigger funds, like we're more like a private equity multi-strat. We're more of like an emerging growth fund, right? So we're a little different. But my experience, so the guys who are running like the large Bitcoin desks or the Bitcoin funds, they're doing it's a lot more. Bitcoin's a lot more efficient. Okay. So, because it has a lot more kind of liquidity. So they're looking for those nits and nats. In fact, we are launching a Bitcoin futures fund based on an algo that we've licensed that's going to be running, you know, it's like 84% actually year to date. And it basically is an AI futures. So it looks at the market and looks at the momentum. A lot of this stuff is momentum driven. So similar to the equities market. The other thing that we noticed on the algo side, is that there's a correlation between, so there's a correlation, so everything's correlated on a pair to Bitcoin. So if Bitcoin goes down, right, all the altcoins go down. If Bitcoin's going up, all coins start to separate. They start to decorrelate based on the project. But when the market's going down, everything's going down. So we were thinking about, well, we should have a Bitcoin hedge to protect it. But then we noticed the other day, like we've been following it, and all this, it's not that correlated enough. We're very correlated to Ethereum though, because most of the tokens are ERC20s, which is based on Ethereum. So if Ethereum goes down, the correlation becomes extremely tight. If Ethereum is going up or the altcoins are going up, the correlation starts to separate. So that's where you have opportunity for art. And most of these larger funds are looking at, they're not doing altcoin to Ethereum or altcoin pair to BTC. They're looking at BTC exchange to BTC exchange. So on Binance, BTC is trading at $10,920. On Kraken is trading at $922. I'm gonna try to take that $2.
All right, thank you very much. That pretty much clarifies it up. And then just a follow-up question quickly on that. On the, Brian asked about the DCF model and in terms of just the construction as well, in terms of modeling what you're sitting on. I wanted to find out when you would construct a hypothetical portfolio, just high level, obviously without giving too much detail, You'd have the crypto assets. Are you rebalancing these with your traditional equities, your fixed income instruments? What's the interplay between the two? Say for a student who's trying to create a hypothetical crypto portfolio that they might look at as a benchmark.
So we have invested. We've invested heavily in the first part of the year, mostly in dealing with tokens, because tokens are liquid, and that's the type of fund that we're focused on. But we are doing more of these, some of the private equity that will, and then very little of the public equity, because there's just not that much to choose from yet. What I would say is, from a portfolio standpoint, if you diversify, like, I believe in diversification, but if you diversify so much, we were just talking about this morning, actually, you're basically going to be the S&P. You might as well just buy the S&P index, So when you diversify too much, it's safer in some ways, but then you're also completely tied to the market movements. If you want to be, you have to find places, you have to do work. You have to research companies and say, we're like value investors a little bit, right? So we're looking for undervalued companies. Like Celsius is a great example. And this is the token, okay? The token was at 11 cents. It's now $1. And we have a price target on it at $1.50. Celsius was just undervalued. And, we were just like, so that's the way we looked at it. And the token represents, in some ways, the token is still representing it almost like an equity in the perception of the market. So when you look at what your diversification strategy might be, is you want to be diversified enough, but like Bitcoin, if you hold Bitcoin, we're pretty sure Bitcoin is going to continue to go up over time. I mean, like 80–90% of the people that are just in the financial markets agree with that. I mean, no one thinks it's going to go to zero. So if you would do that assumption, you could just say to yourself, okay, I'm going to do, equities right now are really overvalued because of the top, literally 5% of the market is dragging everybody with it. So the market looks really big. I mean, the market looks like it's going up, but it's only like the top 10 stocks. So, and a lot of them are overvalued. They're trading at 20 times revenue. So, and that's because of the money printing. So when you look at money printing and all that, so I think from a diversification standpoint, you guys are living in a unique time. So too, this isn't like a normal time, right? 40%, we've printed 40% more money this year than we have in like the last 10 years. So we see Bitcoin like gold, right? We see Bitcoin supposed to be a decorrelated hedge, but for some reason during the COVID-19 and the quantitative easing and all this money printing, if the market goes down, Bitcoin goes down, gold goes down, and oil goes down. That makes no sense from a mathematical standpoint. So what I would say to you is, all of the assumptions that you make in your models, realize that there's some irrational things going on at the same time that really don't make sense, or just haven't played out yet. That's, I guess that would be my warning.
Thank you very much.
Hi, Enzo. I have a quick question. I'm sorry, you go first.
Yeah, I just want to follow up on your earlier talk about the hedging and the hedging strategy for the cryptocurrencies. Are there a market that easily accessible to investors in terms of hedging or derivatives for other currencies except Bitcoin?
There are to a certain point, but not much. And they block U.S. investors. Like, we don't trade in Bitcoin futures yet. And when we do set up that fund, it has to be set up offshore. So there aren't many other pairs. It's mostly Bitcoin, because it has to be very liquid. So Bitcoin, Ethereum, there's a couple of others, but let's say top 5. And most of them are actually, and you have to be very careful with these futures exchanges. I don't want you guys to lose all your money, because these concepts of 100 times leverage is very dangerous, and it's open to retail. It's not. You gotta be very careful. So and then of course in the U.S. I think you can only trade on like LedgerX or the CB, and they're not very liquid contracts wise. So it causes a bit of an issue. Most of the most liquid futures exchanges and options exchanges in crypto are trading offshore. Does that help?
Yeah, thank you.
Okay.
Yeah, I have a quick question. So you mentioned that crypto assets have some similar features as stocks, except that it is less efficient, right? Less efficient. So I think my question is, what do you think about using some traditional trading methods like technical analysis on the crypto assets?
That's widespread. So you should go join, if you go on Twitter. So there's a couple of places where there are some of the best crypto analysts. I mean, they're basically, the technical charting analyst guys, right? The candlesticks, looking at the curves and all that stuff. So there's a lot of that, because because Bitcoin, especially because this stuff is so new and it has no fundamental asset behind it. It's not owned by anyone. It doesn't have the gold back. It's not backed by government. The only way that they've been really looking at it, they spend a lot of time on technical analysis. So you'll see a lot of technical people, and there's some really good technical analysis. There's a guy on Twitter called Plan B. If you look him up, he has some pretty interesting charts, like about flows, really interesting stuff. Like you can go down a rabbit hole, basically. There's a lot of technical information, technical trading, and a lot of these people are options traders, right? A lot of them are options traders. They understand. They do a lot of technical analysis. They understand the momentum, or the commodities traders that they have moved in, or FX. They moved into the space.
Can you give us some name of this Twitter?
So Plan B is one of my favorites. I mean, what I can do is I can send actually kind of Elizabeth, or when I send over the research report, I'll give you guys a couple of Twitter handles to follow.
Yeah, that would be great. Thanks.
No problem.
Enzo, with the amount of stuff you said, as I mentioned, from what you mentioned and from what I understand, a lot of this is offshore. Is your fund in the U.S. or is it up north in Canada?
Oh, so the way I set it up is it's a Wyoming so the fund itself, the LP, is Delaware. The investment manager is actually Wyoming, because Wyoming has digital asset laws that are very, very easy to understand, and it's another way to kind of make sure that we have someone. A lot of states are getting there, and then we have a Canadian trading desk, because most of the exchanges are blocked the U.S. So in our PPM, in the offering documents, we're pretty clear. This is crypto, so we do try to trade on U.S. exchange as much as possible, but because we're in the altcoin space mostly, that's kind of hard to do. But it's getting easier every day. I mean, as it evolves, and there's definitely a movement towards coming up with what the proper regs are. We have there's a well-known SEC person. I forget her name. Her first name's Esther, but so she is there we go. Actually, Hester Pierce. So actually, Hester Pierce, she is like what we call the crypto mom, which is kind of like it's a cute term, I guess. And she really understands what blockchain is. She understands the digital asset world, and she's kind of been the champion at the SEC. She just recently re-upped for like the next couple of years, so we know she's going to be there. We would love for her to become chairman, but we'll see. But what's interesting is the former general counsel of Coinbase is now the comptroller of the currency. He's the one that has allowed U.S. banks will now be allowed to custody cryptocurrencies. So your Bank of America, your Chase, Capital One, any bank will be also able to hold certain cryptocurrencies, not all of them, obviously, not a lot of the altcoins, but Bitcoin, Ethereum, like the majors.
Understood. Thank you for that insight.
My pleasure, guys. So, any other questions?
Any other questions? Oh, go ahead, Kevin.
Sorry. more from a consumer point of view, I've seen that a lot of wallet offer different type of settings when you want to send Bitcoins or other cryptocurrencies to other wallets. And consumers, I feel like they're not really aware of how they can improve the settings so that depending on the speed they want the money to reach the other wallet, they can like use different settings. Are there any companies that are building this type of algorithms or working on stuff to improve these consumer-based type of products?
Yeah, so the way blockchain works is that those fees are called gas fees, which are basically a fee that is given to all of the people that are running like pockets of nodes. Like, so they're, in order for cryptocurrency to go around, you have to run the nodes. It's like kind of internet servers basically, right? But so there are people who are coming up with lowering those gas fees, because one of the biggest problems is, it's not a big problem, but it's a problem where the bigger the network scales, if it starts to get congested, the fees go up. So they're trying to figure out, there's a bunch of companies trying to figure out ways to create lower fees so that transactions are much cheaper. Because we have to be the fees have to be less than if you are using, even Venmo, right? So, because why would you use it then? So it has to be just as fast, and it has to be just as secure, more secure. It should be more secure, and the fees have to be less in order to get the mass adoption play that you're actually kind of alluding to. So yeah, there's a bunch of blockchains that are working on it, like the Solana guys, Polkadot. Most of them, and none of them are based out of the Bay Area. They're funded by kind of Andreessen Horowitz and big VC funds. So yeah, it's pretty interesting what's going on. I try to follow those firms also.
Thank you.
Enzo, thank you very much for your time. Liz, again, thank you. And Zane, as usual.
Thank you.
Thanks
and
for
nice
helping
meeting
out
you
for our
folks.
understanding. We're actually going to be teaching a course in blockchain starting next year on our program, even though
Fantastic.
we're already working on it, but
Fantastic.
you're right, that's the future.
Sounds good. And thanks, Liz.
Yeah, Enzo, wonderful having you. Thanks for joining us. What's the best way if students want to continue to follow you or connect with you in some way? Maybe they want an internship or looking for a job at some point. How can they connect with you?
I can give you guys my email or something, or you can follow me on Twitter or whatever. So I'll just put it in the chat, Liz, or should I just send it over to you guys? To you.
You can put it in the chat, yeah, and I can send it out after also.
Yeah, send it to Liz.
Cool.
Great, thank you.
All right, everyone. Thanks again, and have a great day.
Okay.
Bye, you guys.
Thank you.
Thank you.
Thanks.
Thank you.
Thanks. Yeah.
Okay. We're alone now. Falling Knives. Ricky?
Hi, sir. Yeah, I'm
Hey.
reminding them to come. How are you, sir?
Good, good. Go ahead. Tell us what you're doing.
For this week, we continue improving the performance of our model. As remind before, we already have a math model for that, and we already coded, and we did some prediction on the data we have, and we performance perfectly in the training part, and we have a little problem in the test part, so we continue improving the performance in the test part. And there are some problems we realize that we need to solve. The first one is overfitting, and we realize that because the stock market has a lot of noise about for example, if a stock increased dramatically in the first month, and then it will have a bigger opportunity bigger probability to get the falling knife, because it's not very normal to increase such a lot in the first month. And there are also some noise about if a company bankrupt, and if we put this company into our data, it will make a very big variation. And we're trying to solve that. And another problem is we realize that the stock market is disordered, and we have to, and if we just use the simple support vector machine to predict it, it will be a very big error. And we are trying to use the imbalanced support vector machine to solve this problem. But if we use that, we have to put some weight on each individual set, and it will become a optimization problems. And we are working on like define the objective function and to maximize the accepted benefit for profit for a portfolio investment.
And
portfolio.
who's working on that, Ricky?
And actually all of us is working on that because it's a
all 9 of you.
Yeah, comprehensive problem. We can't really define like which very specific problem where any individual person is solving about. We have to like combine them together. And some of the like Hao Chenshi, Yixing Wang, and Zwan Peng is working on the indicator because we have to find a more indicator which like have a very high correlationship with these stocks and the stock markets, and they are researching on some paper. And Huadong.
Which paper are you working on? Which paper? Ricky, which paper? Can you send me the paper that you're working on? That you're looking at?
Which paper? Yeah, we can get it later. It's about it's a math paper. We can get it, but actually it's in Chinese, but the formula is math.
Yeah.
Yeah,
it's important to show me outside work because the more you interact with the outside, the better off you're going to be.
Actually, yes, we can write something to you. We can write a one-page like things to introduce. And actually, we get some trouble, and actually we are trying to build a like software. You can think it's an app to predict the falling if the stock will recover in the future if the stock have a falling knife. And
if you have an app built, that would be fantastic.
Yeah, and actually the UI part is like is not so difficult because we can just build a like very simple like interactive how can I say it? An interactive plate, like we can just input the
interface,
data
user friendly interface. Yes, great.
Yeah, but actually for the math part, we have some trouble because for now we already have a predict model, and this is all about our mathematic knowledge. But for the further question, we just think it's a little bit beyond our knowledge, and when we math some problem, we just don't know like which math how can we solve that. The only optimization problem we can solve is the convex things, but stock is kind of not convex, and we just talking about it. And is it possible for us to have a like professor which can help us to like point us?
Well, I don't know if Jordan is still here. These guys, that's exactly what they did. They went out and they reached out to Louis Zulaga, for example.
Can I, Ricky, I have a question for you. How many years are you using for training, validation, and test?
Actually, we have the data from like 2004 to 2018 and 2020. I have to check that. I just forgot what the specific year. About like 20 years, 15 to 20 years.
How much of that data is training? How much of that data is validation? How much of that data is testing?
Actually, we're not using it's about like 150 49%, and we just use the 30% for training, and we just 70% for training and 30% for the testing. And we just did the interactive test for our model.
We have 20 years and 30%. So you're using 6 years. So you're using about 5 to 6 years for training. If you have 20 years and 30%.
No. Actually, we don't classify it as years. We just recognized about 98 technical stocks, and every stocks have 49s in the past 20 years. Like maybe company A has like 3 49s, company B have 5 49s. We just put any one individual 49s as a sample, and actually it has 150 49s happened in the past 20 years. So we have 150 samples, and we just separate like 70, 30. Can you understand?
So
does that make sense?
So is
That
it
makes
different?
sense. I'm not going to go deeper. That makes perfect sense to me. I'm just not going to go any deeper than that. Thank you.
Great. What else do we have? How about Inca and AEDC? Who do we have? Ben, are you there?
Yeah, no update on AEDC. I'm going to try to find time to talk to, I think it's Jim, hopefully before.
Yeah, you got to talk to this guy too. He's a very, I don't think you've ever met him. Well, Jim is, he made his money in real estate, so he's kind of, I wouldn't say aloof, but he's pretty good. He knows what he's doing. But he tends to be very general. But I think if you talk to the other guy,
Scott, yeah, Scott.
Scott is the builder.
Yeah, I think he's the guy I meant to talk to.
I think you want to talk to.
Mm-hmm.
And Inca Digital. Who do we have on Inca Digital? Ben? No.
I'm on Inca Digital. So this week we made a lot of progress actually. Nick actually shared a document, basically a template with some loose threads that we could look into, and he also gave us some pretty good examples for us to investigate. To as a topic for our research project. So
you all participated in. Yeah. So you submitted your. No, you haven't submitted your. Yeah, he gave you a template. You haven't used a template yet, right?
Yeah, we haven't. I have not used a template.
Okay. So as soon as possible, enter the template.
Said within the next like 10 days, he wants us to kind of, he said a lot of our research topics were very general. So he wants us to make them a lot more specific and then send him an actual like null and alternative hypothesis, things we can test, and how to kind of quantify our data. So he sent us a template for that. And he said within the next like 10 days to 2 weeks, he wants us to kind of finalize that so we can really dive deep into our research. But for the kids who on the Splunk training yesterday, he also shared a video showing how to actually quantify like sentiment analysis using the different APIs. So if anyone wasn't on that, I think he emailed it to us. It's very helpful.
Yeah, the video. Were you on that call, Mike, yesterday?
Yeah.
And Karen, you were on that call, right?
Yeah.
Kai, were you on that call from?
Yeah.
I think that's it. I mean, here and yeah, and you should be on that call if you have the time and if you have a class, because it'll be good. I mean, it's a good training ground. Now, I'm going to talk to this guy next week. Maybe I have you on that call as well, because I think let's see how we do. But I'd like to take all these and see if we could push them into that project that he's trying to do as well. Right? I mean, maybe there's something one of you has that is quite interesting let's see. I mean, right now, oh, Marcella is here too. I'm sorry. Continue your own project, but let's listen to what he has to say as to how he wants to conduct. I'm talking for the research project for the that he wants to submit to the Navy.
Oh, are you talking about the Air Force one?
Yes.
Okay, sorry.
So I want to hear what he has to say, because maybe he's got some ideas already, and he needs bodies to work on it, right? Maybe he wants to grab some of your ideas and make into a, you know, let's see how he wants to play it. But it's definitely interesting, and it definitely opens and you guys have got to be in there, as Enzo said, the CEO. You got to know what's going on, right? And this is one great way of doing it. And I'll see if I could get close to Enzo some fashion here. I will let you know when the call is next week. Salah, you okay with that?
Yes.
Salah, you okay with
Yes,
that, right?
Prof. Yes, I'm all right. As well yesterday. So.
Okay, so if nothing else, I think we're done. Right?
Thank you.
Guys, good? Kai, don't forget, you also need to submit your idea, right?
Oh yeah, I already shared my topic with Nick, but I just
you need to use the format. Right? Yes.
Right.
You have to use
okay.
the template. Okay, we have to firm it up a little bit. Okay, guys, see you next week.
Thank you.
Take care.
Thank you.
Take care.
Bye.